Hello everybody, welcome to our video. I'm Guan, one of the co-founders of AllQuant, and in today's session we're going to cover something very basic but at the same time also something very essential for those who are starting out in their investing journey, and that is we're going to get to know the most popular asset class among investors, which is stocks. Okay, we're going to look at answering a few very basic questions here. First, what are stocks? Second, why do companies list their stocks on exchanges? Third, why do people even want to buy stocks? Fourth, what are the risks involved when you buy stocks? And lastly, how do we go about buying stocks itself? Alright, so without further ado, let's dive in. First question, what are stocks? Now, stocks are financial assets. Okay, so they're not something physical or real like buying a piece of land and a apartment of gold bars. So what stocks do is simply let you have an ownership and share in the future earnings of a company. And they do have another name. They're also very commonly known as equity, especially within the finance industry itself. And they represent a fractional ownership in a company. So imagine I can slice and dice the company stocks into many different equal parts. And each part of each unit of stock in this company is called a share. So to illustrate this concept, imagine I got this bar here which represents 100% ownership of a company. What I can basically slice this up into many different equal parts, okay, and each slice of it is called a share. And in this case here, there are 20 shares, and let's say there are 2 shareholders in the company, Jack and Jane, and Jack holds 5 shares, and Jane holds 15 shares. So in terms of percentages, right, that equates to Jack owning 25% of the company and Jane 75%. All right, simple. Now, there are also different types of companies. So there are public companies, then there are also private companies. So public companies are those that are listed on a stock exchange, such as a popular Apple, Microsoft, IBM, Meta, right? So anyone can go about buying and selling the shares of these companies. Private companies, on the other hand, they are not openly traded on stock exchanges. So the shares of these companies are usually held by a private group of individuals or some other business entities itself. Well, there are also different types of shares. Okay, there are ordinary shares, there are preferred shares, there are redeemable shares. Okay, but the type of shares that we usually buy and sell on the stock exchange are the ordinary shares. They also have another name, they're also called the common shares. Alright, so these shares come with voting rights that lets the shareholders vote on important corporate decisions. And of course, the more shares you have, the greater the weightage of your votes. Now, listing a company stock on exchange, right, is an expensive and laborious process. Okay, and it also subjects the companies to a lot more compliance and regulatory scrutiny. So if that is the case, then why do companies want to list their stocks on exchanges? Alright, the main reason is actually very simple. It is to raise funds. Okay, so companies go through this process called the initial public offering, or in short IPO, right, to list their stocks on exchange. And through the IPO, they'll be able to raise the funds they need to finance their company's growth and operations. So this approach gives them the maximum reach, right? Because they can basically tap on the public, meaning virtually anyone, right? In order to raise their funds itself. All right. And listing on the exchange, right, is also not only a convenient means for people to invest into the company. Okay, it also provides an easy means, right, for people who want to cash out. So this ability to get in and out of investment quickly and easily is what we call liquidity. And if you think about it, it is also a good way for entrepreneurs, right, who build up the businesses to unlock their wealth. We have looked at things from the perspective of the company. So the next question is, why do people want to buy stocks? Right? What is their motivation? What is their aim? Now, the reason is very simple. So people want to buy stocks in order to participate in the growth of the company they believe in. Okay, or they believe the company is going to do well. And in the process, that is going to make them profits and money. And these profits come in 2 forms. All right. So the first is what we call capital appreciation. So as a company grows, right, the share price can increase from where you initially bought it. Okay, and that's what we call capital appreciation. So the second is dividends. So dividends is a form of payment from the company itself, usually in cash, and they are the company's way of distributing the earnings to the investors. So it is not guaranteed, and not all companies issue dividends, but many do. Okay, let's get a better appreciation of this with an example. Let's say we bought into Apple shares when it is $129.41 at the start of 2021. Then at the end of 2021, the share price increases, right, to $178.20. So that means that for each share of Apple that we hold, we make $48.79 on it. Okay, but that is not all, because Apple also pays dividends as well. And in 2021, it paid dividend 4 times with an amount totaling up to 86.5 cents. Okay, so if you include dividends in, right, all in all, you made $49.65.5 on each share of Apple that you hold. What are the risks when you invest in stocks? Now, nothing comes for free. Yeah? You cannot expect to make good money without taking any form of risk. But having said that, very often the risk aspect of investing is neglected. All right, so let's take a look at the risks involved, right, when you invest in stocks itself. Now, stocks is considered a risky asset, right, which is sensitive to economic and business cycles. And that is intuitive, right? Because if you think about it, when the economy is doing well, businesses tend to grow and do well. And in return, your share price will increase, right? But similarly, right, in a downturn, your business is going to suffer, right? And then the share price is going to fall. So now, stocks as an asset class, they give you a high upside relative to other assets. All right, so US stocks in aggregate can deliver you about 8 to 9% and maybe a little bit higher, right, on average a year. And there are also individual stocks that can deliver you astronomical returns, like a few 100%, right, if you pick the right one. But having said that, that is a big if. Okay, now the flip side of this is that stocks also can potentially have very large downsides. But if a company that you invest in goes bankrupt, which it can happen, right, for many different reasons. But when it happens, you can potentially lose your entire investment in that company. So that is why a lot of people diversify. Okay, so having a diversified portfolio of different stocks can help in this aspect. But even then, you can still experience large losses when crisis hits. Okay, so this is how the S&P 500 performed, right, during some of the major bear markets and downturns in the US history. So for those who do not know, the S&P 500 is a basket, or represents, right, a basket of stocks that comprises the 500 largest public companies in the US. So these are like your established large blue chip companies here. Okay, but even then, right, if you notice during this crisis, they can still go down quite a fair bit. And the worst was back in the 1920s, where we have the Great Depression, right? It fell more than 80%. Then in the dot-com bubble in 2000, it fell close to 50%. And in the great financial crisis between 08 and 09, it plunged 57%. Okay, then in a more recent episode of the COVID-19 pandemic sell-off, right, it dropped about 34%. All right, so if you're holding stocks over the long term, the probability of you realizing those losses are probably lower. Okay, but having said that, you never know when you might need to sell these stocks. Okay, so this risk is definitely still there. Alright, so how do you go about buying stocks? Right, the process is very simple. The first thing you need to do, right, is to find yourself a good and reputable broker, right? For example, Interactive Brokers, right? And usually when you open an account with the broker, right, they will offer you 2 options. One is a cash account, the other one is a margin account. So a cash account means that you need to fully fund your purchases. So if you intend to buy $10,000 worth of Apple shares, then you need to have at least $10,000 of cash sitting in an account. All right. And a margin account, right, on the other hand, is an account where the broker can lend you, right, extra money when you need it. So they may say lend you $1 for every dollar that you have. So with $10,000, right, sitting in an account, you can actually, let's say, purchase up to $20,000 worth of stocks. Okay, but having said that, take note that in the meantime, you would have to pay financing charges for what you borrow, and you're also, right, taking on higher risk. All right. Then thereafter, what you need to do is just to fund your account, right? Deposit cash into that account. And once that is done, you can start trading. So you can start buying and selling stocks. All right, so that's all I have for today's session. And I hope all of you have learned something of value here. Now, if you do like the video, help us, do us a favor, and do let us know by clicking on the like button below and subscribe to our channel for more updates. Right, and just for info, at AllQuant, we also conduct online courses regarding investing. So if you are interested to find out more, you can visit our website for more information. So the links to our website is in the YouTube description below. All right, so all the best, and I'll see you in the next video.